Good evening. We're going to talk a little bit about the balance sheet now. And before we populate it with numbers and figure out how that all works, let's look at the two sides of the balance sheet. On the left, we have assets, and on the right, we have liabilities and equity. Let's start with the left-hand side. We can see that cash is at the very top and that intangible assets are at the very bottom. So that tells us that the most liquid assets are at the top and the least liquid or the most illiquid assets are at the bottom. And so the arrangement of assets on the balance sheet go from most liquid down to the least liquid. In our most liquid category, which we call current assets, we have cash, accounts receivable, and inventories. If we also had prepaid expenses, they would be up there. The total of all of those assets that subtotals into current assets. The next category are our plant, equipment, and land. And in this case, our gross fixed assets are the plant, equipment, and land at book value. We then have to deduct accumulated depreciation, which is the amount of depreciation that has built up over time, and that will give us net fixed assets. Finally, we have a category called other assets, and that includes investments, and that's not investments in the stock market, that's investments in things like other companies, which you could not turn around and quickly sell, and intangibles. And within intangibles, we would find things like patents or covenants not to compete or goodwill, something that we would depreciate or amortize over time. And we would total those up and we would have total other assets as well. If we take each of these subtotals for current assets, net fixed assets, and total other assets, add them together, we will get total assets. That's it for the left-hand side of the balance sheet. Now let's move over to the liabilities and equity side. Let's begin with the liability side. The liabilities that we owe most currently, the ones that sorry, the liabilities that we're going to owe the soonest are at the top of the list. So those would be accounts payable, and that's money due our suppliers, accrued expenses, and those are expenses that we've accrued but not yet been billed for, and that might be something like payroll to our workers. We also have short-term notes payable, and that's notes that are due within 12 months or amounts that are due within 12 months. If we total all of that up, we get current liabilities. Please note that two of these things are called nibbles, non-interest bearing liabilities, and that's accounts payable and accrued expenses. That's because we don't pay our suppliers interest and we don't pay our employees interest while they wait for their paychecks. So those are non-interest bearing liabilities or nibbles. The short-term note payable to the bank does bear interest, so I've noted it as IB interest bearing. And that's because the bank does not loan you money without collecting interest. Moving on down, we have also long-term debt, and this is debt that's due in greater than 12 months, and it is also interest bearing. And right now, that's all we're going to put in our total long-term liabilities. If we want to know our total liabilities, we take our short-term, or current liabilities, and our long-term liabilities, add them together, and that will give us total liabilities. Next, we come to the equity section of the balance sheet, and that's where we find common stock, preferred stock, retained earnings. Common stock is the stock that we've issued. It shows up on our balance sheet at par value, and the same for preferred stock. And retained earnings is a sum of all of the earnings that we've plowed back into the company since the first day we opened the doors of the business. Those three things together in our simplified balance sheet. There can be many more complicated things that show up in equity, but for now, this will be good for our class. Those are the three things we're going to count, and those add up to total shareholders' equity. We can then take our total liabilities, add it to our total shareholders' equity, and we'll have total liabilities plus equity. The most important thing to remember about the balance sheet is that it balances. That means the assets or must total exactly what the total liabilities and equity total. So if this were 500, this would need to be 500. And we're going to see that as we do an example. So let's go ahead and we're going to pick up an example from another spreadsheet of a number of items that we're going to try and figure out where they go in the balance sheet. So let's put these on here so we can all see them. Yeah, not so lucky. Let's try that again. And this is for Ryan's jet ski rentals. And any of you know Ryan, you'll know he's quite the jet skier and a very good guy too. All right. Ryan's. Where do we want to put our cash? Well, we're going to pick up that $4,000 and we're going to put it right up here. There we go. Next, we have to find our accounts payable. Well, if it's a payable, it's probably on the liability side. So we're going to go up and look, and there it is. So that is going to be $6,500. Next, we have depreciation. And we are not going to use that because it doesn't say the words accumulated depreciation. That's lower down here. This depreciation item belongs on the income statement, so we're not going to count that. Same thing with taxes. Those don't belong on the balance sheet. They belong in the income statement, so we're going to skip that one. Our accounts receivable, a whopping $23,000. Next, we have our interest due. That's an income statement item, so we're not going to work with that right now. Our notes payable within 12 months. That means that's going to be in our short-term or current liabilities, and we're going to find a spot for it right there. Next, we have our plant and equipment, which is $240,000. And we have our long-term debt. That's going to go on the liability side right here, and that is $60,000. So you can see we're taking a pretty jumbled up list of accounts and amounts, and we're fitting them into our balance sheet. And this is something you're going to want to be able to do very quickly and easily by the time you finish this course, because we'll be doing a lot of it. So we just finished with our long-term debt. Let's look for a spot for inventory, and that does go right up here in our current assets. Dividends, that doesn't belong on the balance sheet. Cost of goods sold, that belongs on the income statement, so that doesn't belong here. But finally, we're to accumulated depreciation. And remember, that's a contra account, so we want to put it in as a negative number so that we end up with $51,000 for our net fixed assets. Our common stock is our next item down here in our list, and we do have a spot for that. We've got sales of $350,000. That belongs on the income statement. And finally, we've got retained earnings of $2,500. So in this particular case, we do not have any investments and we do not have any intangibles. Moreover, we didn't have any preferred stock. So we're going to put zeros in for all of those. The nice news is that our total assets equaled our total liabilities plus equity. And you can see that the current liabilities of $31,500 plus the long-term liabilities of $91,500 totaled $123,000, to which we added $3,500 of shareholders' equity, and that's not possible. Let's fix that. Our long-term liabilities are just $60,000. Now let's add our $31,500 to our long-term liabilities of $60,000. That brings us to $91,500, and we add in our total shareholders' equity of $3,500 for a total of liabilities plus equity of $95,000. One would hope. Total liabilities plus total equity. There we go. And they do match, which is great. And that should be it. I'm wondering if we should do another one. Why not? Let's do Brian's Sports Collectibles. If you think you've already got this, you don't need to continue with the video. You can turn it off, but if you'd like to, you can do Brian's Sports Collectibles with me as well. So let's go ahead and get rid of these so that we have plenty of room to practice in. There we go. So we've got zero on both sides. We're in the right category. Our cash we show is $60,000. We've got accounts payable, which we know is a nibble of $35,000. We've got depreciation of $12,000. It doesn't say accumulated in front of it, so we're not going to use it. We know taxes belong on the income statement, so we won't be using that. But we will be using $48,000 from the AR as the AR. Interest of $23,000, irrelevant to us, but we do care about the notes payable due within 12 months. And that would be our short-term notes payable, and that was $100,000. Make sure we have enough zeros there. Good. Next we have Plant and equipment of only $20,000. Pretty light on fixed assets, gross fixed assets there. Long-term debt of $200,000. We know that belongs over here on the right-hand side of the balance sheet. We've also got inventory of $250,000. That's quite an inventory number. I'm already beginning to question Brian's business skills. Dividends, irrelevant to us. Cost of goods sold, doesn't matter for this particular exercise. That would matter if we were doing the income statement. Here we are, accumulated depreciation. Put that in as negative 18,900. 20,000 minus 18,900 gives us net fixed assets of 1,100. That looks about right. We've also got common stock of $4,500. Let's put that in. And we've got sales of 350,000, irrelevant to us, belongs on the income statement. And finally, we have retained earnings of 19,600. So let's put in a 0 for our preferred stock, a 0 for our accrued expenses. Apparently we have none of those. Nothing in investments, nothing in intangibles. That gives us total assets of 359,100 compared to 359,100 of liabilities plus equity. So again, a success